All right, so it's January 17th, 2025. And you know what that means. It's the perfect time to start thinking about retirement savings. We're doing a deep dive today into an article from Skloff Financial Group, all about the 2025 retirement plan contribution limits.
Yeah.
One thing that really stuck out to me in this article was that a lot of people are worrying they haven't saved enough, especially with all the uncertainty surrounding Social Security and Medicare these days.
Yeah, that's a really valid concern, and that's exactly why maximizing contributions to these tax-advantaged accounts is so important. They can really make a huge difference in how prepared you are for retirement.
Absolutely. I was thinking the exact same thing. This article kept using the phrase tax-advantaged savings vehicles. What exactly does that mean? What's so special about these accounts?
Okay, so imagine this. You put money aside for retirement, you get a tax break right away. Plus, that money can potentially grow tax-free for years and years, even decades. That's the power of compounding. Your money is basically earning interest on interest. It snowballs over time.
Okay, I see. So it's not just saving, it's like super saving.
Yeah.
I like it. So this article breaks down a bunch of different types of these plans, starting with 401k, 403bs, and 457b plans. Are those the most common ones that you see?
Oh, yeah, for sure. Those are the most common plans. They're kind of the workhorses of retirement savings for most people. And guess what? For 2025, the contribution limits have gone up again.
Oh, wow. Tell me more.
All right, so for those under 50, you can now contribute up to $23,500. That's a little more than last year. And if you're 50 to 59 or even 64 or older, you can contribute up to $31,000.
Okay, so the limits have gone up. That's good news.
Yeah.
Can you explain what those extra contributions for people 50 and over are?
Yeah, so those are called catch-up contributions. It's a really smart way to boost your savings as you get closer to retirement.
So like you're trying to catch up.
Exactly.
Now, the article also mentioned a combined contribution limit, which includes what your employer puts in. What's that all about?
That combined limit is important, especially if you have a good employer match. Let's say you max out your contribution at $23,500, and your company matches 50%. That's an extra $11,750 just for saving for retirement.
Wow, so that's a pretty good deal. Now, the article also talked about traditional versus Roth versions of these plans.
Yeah.
Is that something that we should be thinking about right now?
You know, it's a decision you'll want to consider carefully. With a traditional plan, you lower your taxable income now, but you pay taxes when you take the money out in retirement. With a Roth, you pay taxes now. But withdrawals are tax-free in retirement, so it really depends on your individual situation and your expectations for future tax brackets.
Sounds complicated. We might need a whole other deep dive just for that. Okay, so we've covered 401ks, 403bs, and 457ds. But what about SEP and simple IRAs? The article mentioned those as options for small business owners or self-employed people.
Yeah, those are great options too. They have their own unique advantages. SAPs, or simplified employee pension plans, are really great for business owners because you can contribute a pretty large chunk of your compensation, up to 25%, with a maximum of $70,000.
Wow, so if you're running your own business, you can put away a lot. That's good to know. What about simple IRAs? What are those all about?
So simple IRAs, which stands for Savings Incentive Match Plan for Employees, are also designed for small businesses. With a simple IRA, employees can contribute up to $16,500 if they're under 50, or $20,000 if they're 50 or older. And one thing that makes them unique is that employer matching is actually mandatory.
So you're guaranteed to get some extra help from your employer on top of your contributions. That's a nice little bonus. Now, the article also talks about traditional and Roth IRAs. Are those only for certain types of workers?
Nope. Those are available to anyone, no matter where they work. They're great options for everyone looking to save for retirement.
So it sounds like there's a lot of different options out there to help people save for retirement, and it's important to choose the one that's right for you.
Exactly. There's no one-size-fits-all approach. It's all about finding the plan that best suits your needs and taking advantage of all the benefits available to you.
So let's dive into some of those benefits and strategies for making the most of these plans in 2025 and how to really maximize those contribution limits.
Sounds good to me. Let's do it.
So we've covered all these different retirement plans and their contribution limits for 2025. It's great to know what's out there, but honestly, it can feel a little overwhelming. Like, where do you even start?
I totally get it. It's one thing to know the rules, and it's another thing to actually put them into action. But the good news is, even taking small steps can make a really big difference over time.
Okay, so I don't need to become like a financial expert overnight. Phew, that makes me feel a little better. What would you say is like the most important first step?
I think one of the simplest and most effective strategies is to automate your savings. You basically set it up like you're paying a bill. You set up an automatic transfer. from your checking account to your retirement account, every month. And you probably won't even miss the money, but it'll be steadily growing for your future.
Oh, that's a great idea. So it's like totally hands-off.
Pretty much.
And speaking of making things automatic, what about those employer matching contributions? Is that really like free money?
It really is. If your employer offers a matching program, make sure you're contributing enough to get that full match. It's basically an instant return on your investment.
Yeah, it's like getting a raise and then immediately investing it wisely.
Right.
Now, I know that retirement isn't the only thing that people are saving for. What if you've got other financial goals, like buying a house or paying off debt?
That's a common challenge for sure. And there's really no one-size-fits-all answer. It's all about finding what works best for your situation.
So how do you balance all of that?
Well, you might decide to focus on paying down high-interest debt first. And then once that's under control, you can shift your focus more towards retirement savings.
So you got to kind of prioritize.
Exactly. You can also think about contributing a smaller amount to retirement now while you're still working towards those other goals.
Gotcha. So it's like a balancing act, making sure all those important areas are getting attention.
Exactly. And remember, even small, consistent contributions can really add up over time. Think about it this way. If you contribute just $100 a month and you start at age 25, by the time you reach 65, you could have over $120,000 just from that small, consistent contribution, assuming a 7% average annual return, of course.
Wow, that's pretty amazing. I guess it really shows the power of starting early.
Absolutely.
But life happens. What if you have some unexpected expenses and you're tempted to dip into those retirement savings?
Well, it's important to remember that those accounts are designed for long-term savings. If you withdraw money early, you're not only losing out on that potential growth, but you could also face some pretty hefty penalties and taxes.
Ouch. Yeah, I definitely want to avoid that. So we've talked about automating savings, taking advantage of employer matching, balancing different financial goals, making consistent contributions, and resisting the temptation to withdraw early. Are there any other tips for making the most of those 2025 contribution limits?
One thing I always emphasize is to regularly review and adjust your retirement plan. Your life changes. Your financial goals change, and your plan needs to adapt to those changes as well.
Yeah, that makes sense. So it's not just like a set it and forget it kind of thing.
Not at all. You should review your plan at least once a year, and maybe even more often. If you go through a major life change, like getting married or having kids, buying a house or starting a business, all of those things can impact your finances, and your retirement strategy needs to reflect that.
Okay, so stay proactive. Got it. So we've covered a lot of ground today. We've looked at all the different retirement plan options, their 2025 contribution limits. We've talked about some smart strategies for maximizing your savings. But there's one piece of the puzzle we haven't really tackled yet: choosing the right investments within your retirement account.
That's right. And that's where we'll dive in next. It can be an intimidating topic for some people. But once you understand the basics, it's really all about making choices that align with your goals and your risk tolerance.
All right, so welcome back to the final part of our deep dive into maximizing your retirement contributions in 2025. I feel like we've covered so much already. Different types of plans, smart saving strategies. It's a lot to take in.
Yeah, we've been busy. But now it's time to tackle what can be the most intimidating part: choosing the right investments for your retirement account.
Oh yeah, that's definitely intimidating. It's kind of like walking into this giant investment supermarket and trying to figure out what to buy for like the next 30 years. Stocks, bonds, mutual funds, target date funds, like where do you even begin?
I get it. It can definitely feel overwhelming. But just like with grocery shopping, if you have a plan and you understand the basics, it's really not that bad.
Okay, so let's make a plan. What are some of the key things that you should think about when choosing investments for your retirement account?
Well, the first thing you need to consider is your time horizon. Basically, how long do you have until you plan to retire?
Okay, makes sense.
So the longer your time horizon is, the more risk you can typically handle. And that's where the concept of asset allocation comes in.
Asset allocation, what is that?
It's actually simpler than it sounds. Think of it like this. You're dividing your retirement savings pie into different slices.
Okay, I like pie.
Right. So those slices represent different types of investments, like stocks, bonds, real estate. And how big each slice is depends on your risk tolerance and how long you have until you retire.
So someone younger with more time might have a bigger slice of stocks because those tend to have higher returns over the long term.
Exactly. And someone closer to retirement might want a bigger slice of bonds, which are generally less risky but also might not have the same potential for growth.
So it's about finding the right balance between risk and reward.
Exactly.
And you mentioned stocks and bonds, but even within those categories, there are like a million different options.
Yeah.
What about things like mutual funds and ETFs? What are those all about?
So mutual funds and ETFs are basically like pre-made baskets of different stocks or bonds.
Interesting.
They allow you to invest in a bunch of different things without having to pick each one individually.
There's less work for me.
Exactly.
What's the difference between a mutual fund and an ETF, though?
The main difference is in how they're traded and their fees. Mutual funds are typically bought and sold through a brokerage firm, while ETFs are traded on stock exchanges, just like individual stocks. And ETFs usually have lower fees, which can make a big difference in your returns over time.
So fees matter.
They really do.
What about those target date funds? I feel like I hear those mentioned a lot, especially for retirement accounts.
Yeah, target date funds are a great option, especially for hands-off investors. You pick a fund with a target date. That matches your expected retirement year. And the fund manager basically takes care of everything else. They adjust the mix of stocks and bonds as you get closer to retirement, so it gradually becomes more conservative over time.
So it's like a set it and forget it kind of thing.
Pretty much.
Okay, that's cool. Any other key things to keep in mind when choosing investments for retirement?
Two really important things: diversification and regular review.
What's diversification?
It means not putting all your eggs in one basket. You want to spread your investments out across different asset classes, different industries, different geographic regions. This helps reduce your overall risk.
So don't put all your money in one stock.
Exactly.
Gotcha. And what about regular review?
Well, as your investments grow and market conditions change, you might need to rebalance your portfolio to make sure you're still on track.
It's like giving your investments a regular checkup.
Exactly.
And if you're ever feeling lost or confused,
Don't be afraid to reach out to a financial advisor. They can help you create a plan that's specifically tailored to your needs.
great advice. Well, I think we've covered a ton of ground today. We explored all sorts of different retirement plan options, their 2025 contribution limits. We talked about smart saving strategies and even how to choose the right investments. My brain is full.
Mine too. But the important thing to remember is that time is on your side. The sooner you start saving and investing, the more time your money has to grow.
So don't wait. Start building that brighter financial future for yourself today. That's all for this deep dive.